All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing very well. I still can't hear well because we were sitting pretty close Luke Bryan concert last night. So very loud, a lot of fun, but got my signed hat. So shout out Luke Bryant and the team. Put on a great show.
I love it. So that's the Las Vegas lifestyle. You are in Las
Yeah,
Vegas right now as we speak in your new home, correct?
correct. Yes, I am. Yep.
I love it. And you're loving it?
Oh, absolutely. Yeah, we might actually just impromptu go to a Lady Gaga concert tonight. So there's a lot of stuff to do here. I'm glad we made this choice. A lot of fun.
I love it. So let's get right into the show. This is for September the 8th, 2023. Now, looking at it, talk about the Immaculate Disinflation. What is that? I've not heard that. You're the first person to talk about it. What is it, and what are your thoughts there this week?
It's funny. On the daily financial news for September 7th, so Thursday, yesterday, I talked about it at the open, but I actually think I forgot to define it. So thank you for giving me the opportunity to talk about it. So A, you are not wrong. This is a brand new economic term or vocabulary that some economists are putting out there. Basically, what the immaculate disinflation is a soft landing. Historically speaking, when you talk to economists, they see trade offs. Bring inflation down, job loss has to go up, right? And the whole idea is to kind of, thread the needle where there's, some of this and not some of that. They're now just coined a term. I read my first article. I've now seen it twice. The immaculate disinflation. They're basically saying that the Fed has an opportunity, not a certainty, but an opportunity to successfully bring inflation down, which is called disinflation, to their target of 2% without substantially hurting the job market. Which, if you were to ask a classically a trained economist a year ago, they would have laughed out loud. They'd have been like, oh, that's not possible. We don't, that's not, that it's not how the economy works. I don't know. We got down from 9.1 to whatever it is, 3.3. We get an inflation reading next week. Job market, strong. Yeah, unemployment went up, but we also added job because participation rate. So I'm not in the camp that, immaculate disinflation is happening, but
Okay.
it's certainly worth a conversation.
Interesting. Okay. Interesting. Something that I think we'll keep an eye on. And I like the word immaculate, right? You think about baby Jesus, right? And the
Yeah,
whole immaculate conception, so it's like, okay, this could be a brand new, like you said, the soft landing.
could
Interesting.
be. Yeah, it's
Interesting
certainly worth
times.
a conversation. Yeah.
I love it. We're going to talk more about that as we get deeper into the show. I love finishing the year. Also, let's talk about, so for this week, what did you see with jobs? Your thoughts on jobs? Where are we?
Yeah. So again, the jobs number last week, again, last week we recorded on Thursday. It came in at 187, slightly above expectations. However, there was a 100K revision, which net 87 positive, and the unemployment rate went up from 3.5 to 3.8. So that's a lot of
Okay.
words. What happened?
Okay.
The job market is still strong. Why? We added jobs and the unemployment rate up. Let me just tell you this right now. The Fed loved that. More jobs, unemployment rate up. That is almost an oxymoron that's not supposed to happen, right? It
Interesting.
does when you have participation rate. I think I read an article, I referenced it earlier in the week on Tuesday, I think. 1 in 6 retirees are considering coming back to the market. That's exactly what participation rate is. So if you are that one person out of 6, you're not counted in unemployment because you weren't looking. You're retired. You're out
Yep.
of the job market.
Yep.
But the moment you decide to look, you're counted. So the participation rates go up. So that's how you can have a growing job base and a rising unemployment rate is you're pulling people out of retirement looking for work. So the Fed loved Friday's jobs number.
Interesting. Well, again, all good news. And, again, moving in the right direction. I love it.
Yeah,
So
and then
let's,
just real quick on that because I failed to kind of put the period on that. On Thursday, we got the unemployment claims, which is again a weekly drumbeat that we
yeah,
get. It was down again, right? Again, net positive, right? I think it was 212 on an expectation of 235. We were above 260 seemingly 3 or 4 months ago, pretty, for a 3, 4 month stretch, but we are headed down, down, down the last several weeks. So the trend is negative at this point.
Interesting. Interesting. Again, moving in the right direction. So let's talk about, what are your thoughts this week? What did you see this week? Q3, gross domestic product, GDP. What did you see this week and your thoughts about it?
Well, first off, GDP now, which again you could go to, it's the Atlanta Fed. At one time, they were forecasting Q3 GDP, or they were calling it 5.9. Okay. It has since been revised down to 5.6. So still a barn burner quarter. Again, it will be updated for the next, 24 days or whatever it is, 23 days. So it could still go lower, but it's going to be a stronger than expected number. And what does this mean? A lot of the Fed will be forecasting 2023, because the Fed meeting is like January 22nd. We get another dot plot, which again is their expectations. They're going to have to upwardly revise their GDP. I mean, I believe the last dot plot had 2023 GDP at 1%. They're going to have to up that to like 2%, because the economy is looks pretty strong when you look at the numbers.
Interesting. And so with CPI next week, what are, just kind of maybe give us a little projection or just your thoughts, not necessarily a forecast or a, nothing we're going to hold you to, but just kind of, what do you see happens next week, CPI, and what will that mean? Do you think, just kind of the meaning of it? Where does that kind of lead us to?
So I think there's two numbers we're going to have to follow.
Okay.
One is headline, which again went from 3 to 3.3. And it's going to get interesting because oil and gas are up. I mean, oil's at a 52-week high, or at least a year-to-date high. That ripples through. Oil's in everything, transportation, plastics. It's in everything. So it and it's also what you and I feel when we go to the gas station, right? We look at the number. That'll be interesting. But I have been calling for shelter costs to roll over in August, which will be reported in September. Well, now we're here.
Yep.
We're going to see if I was right. So for me, I'm going to be paying attention to shelter cost. If you don't remember, last month when CPI was reported, shelter inflation was responsible for almost 90% of the inflation number.
Yep.
If I'm right, and I'm pretty certain, again, because it's a mathematical equation, shelter rolls over, we should see that impact dented. And we're going to see it dented for the next 3 or 4 months. It's some pretty substantial downward pressure coming on shelter costs, if I'm right. So those are the two things I'm looking at. And the last thing, shelter is 43% of inflation.
Yep.
Oil and gas is 8 to 11%, depending on what you kind of include in there. So it is possible that oil goes up, shelter goes down, and the numbers are negative because shelter is just that much bigger of a contributor. So I'm a little nervous, frankly, because I've been talking about this September report for seemingly a year.
Yeah.
So we're going to find out. We're going to find out if I'm any good at what I do.
Well, I want to just comment on that, though. Even if it's not in September and the number still rolls and it's on the next report, I mean, it's still moving in the right direction. Yeah. And you were clearly recognizing a pattern. It's going to happen, right? I mean,
oh yeah, unless they fundamentally change the kind of equation or math, which I guess I don't put by them, but it feels like a certainty to me. And my guess. Okay.
So let me ask you, and this was something we didn't plan for pre-roll. I got two more things. Mm-hmm. We're going to always finish on opportunity for anybody who, obviously that's the one rental at a time community. That's what we're looking for. What does this all mean? What are the patterns? What are the trends? And where are the opportunities? So that's how we're going to finish. But let me ask you this. This is off just the basic, what we've covered. Do you see clearly with GDP as strong as it is, recession? Do you still see a recession? The Immaculate Disinflation. Do we hit a recession in 2024? Or just kind of maybe some insight, just a little teaser, if you will, about what you see with a recession. Is it still coming? Where are we at, do you think, in the next 6,
Yeah.
12, 18 months?
So big picture first.
Yep.
We will absolutely have another recession.
Yep.
They're part of the business cycle. Next layer. Will we have one in the next 12 months? Dude, I don't know.
Okay.
I think there's a pretty good chance we don't. Now, that's the classic definition of a recession, meaning called
Sure.
by the Economic Bureau of Labor, um, or whatever they're called. I think we're having a rolling recession. As
Yes.
I've said, I think many times, this is far closer to the 1990s than the 1990, not 90s, 90 recession.
Yep.
It's a rolling recession, right? Housing, mortgage hit first. Now housing's coming out. There's a good chance that housing is a positive contributor to GDP in Q3. It's been a negative contributor for, I don't know, 7 quarters or something.
Yeah.
So I think Goldman Sachs call is right. They just updated it this week. It feels right to me. So I'll steal their number. 15% chance in the next 12 months that we have a classic recession.
Interesting.
Yeah, classic. Yeah, so obviously possible, but not my base case.
Soft landing.
Soft landing.
Soft landing, and something nobody I had ever heard talk about, which is, you said, rolling recession. If you're in the real estate industry, I know we've got a lot of realtors, if you're loan officers or even processors, and there's all the different, support of that. Yeah, there has been, with less transactions, it has been hit, like you said, the last 7 quarters. So very interesting. I want to tease also for the viewer or the listener. I've twisted Michael's arm, and we are going to start rolling out conversations about 2024. So we're going to get early on the forecast. We're going to get early in talking about what to expect. 2 things. One is to finish this year strong for everybody out there, 2023, take advantage of the opportunities, but also, okay, what can you anticipate in 2024? I'm going to squeeze and twist Michael's arm and get the best juice to figure out where are we going in this real estate economy. So let's talk about mortgage rates. 30-year mortgage. What did you see this week in your thoughts?
So again, we're still over 7%, but there was something magical that happened on Friday of last week. I saw this at the end of the day, which was obviously after our recording.
Yep.
There was this thing that you and I have talked about, the spread between mortgage rates and the 10-year bond.
Yep.
It broke noticeably below 300 basis points. It got as low as 290, I think, on last Friday. Now, as of today, it's back over 300 basis points. But I think that's a seminal moment. And I think what's happening, this is my best guess, is the volume of business at banks to buy homes is so low.
Yep.
That they are finally competing on price. And now for them, price is interest rate. So they've been living on fat margins. Now that they think we're at or near terminal rate, now that they realize they have to keep their loan officers busy, we could, in the next 3 or 4 months, 3 or 4 months, see the spread come in. Now, I'm not talking anything crazy like 200 basis points, but if we go from 300 basis point spread to 250, that's 0.5%.
Yep.
So again, what does that mean? That means interest rates could fall 0.5% and the Fed does nothing. We're just chewing on what is a historically fat spread. I think Friday was a seminal moment. We have to track it and see if it's a blip. But my current call is we're going to see some competition. And when competition heats up, you'll see that margin collapse a little bit.
I love it. So seeing the margin collapse on those 300 basis points, what does that mean? It means we're going to start to see rates come down, ideally maybe as much as a 1/4 point, maybe as much as a 0.5 point. You think over the next 90 days between now and the end of the year, is that kind of a thought?
I'll ask for a little more. I'll say Valentine's Day 2024, between today and Valentine's Day. So I get half of Q1.
Got it. Okay. That's beautiful. Perfect. Let's finish on a high note. What we always finish on. The whole reason why we're here, Michael, opportunity. What is the opportunity right now as we're in the first week of September, going into the second week? What are your thoughts about opportunity?
So if you're a buyer and you do the work, the rest of the year. And again, I documented success last year, and I'm going to try to do it again this year. Q4 is where you get your your best deals. Disrespectful offers, you can get terms. A lot of buyers will step away. If you're selling, I think the statement is the same. Make sure your exit's below the median. There is no inventory there. And yeah, if you're an agent and it's tough out there, realize you skill up, become a hybrid agent. There are ways that you can become stronger at the end of this. I was talking to a mortgage broker the other day. It looks like their licensees are dropping by 50% over the last 18 months. I think we're going to lose a lot of real estate agents. And I just think there's so much opportunity if you're willing to do the work, study, not gamble, network, tell people what you're looking for, skill up. And I'm excited. I love a slow market. I absolutely love motivated sellers. And this will probably be the next 12 months will probably be my second best time for finding motivated sellers, only being beat by 2010.
Only beat by 2010?
Yep.
Wow. Folks, that's a big deal. 2010 was a bloodbath. That was coming out of the mortgage collapse, all the pre-foreclosures, all of that. Michael is predicting and putting it out there, number 2 to 2010's market, which was an incredible buying opportunity.
Yeah, if you're willing to do the work and not gamble and you got to do, I mean, folks, it's always do the work. If you're doing the work, writing offers, follow up. I mean, last year you were with me. I got 2 properties out of the M list for 30% off.
Yep.
You know,
not even really trying.
Not even trying. So funny. Oh, it happens.
I love it, folks. And I want to second that too, Michael. And the reason why is because in 2010, subject to and seller financing was available, but not so much because everybody was so upside down. You didn't have creative was not
the debt was toxic. It wasn't an asset.
You didn't want it. Whereas today it's an asset. Folks, this is the opportunity to skill up. Michael, any offerings, anything that you want to promote or talk about or share or just tease?
Nope. I'm good to go, man. I look forward to next week's conversation where we talk about 2024. I got a week to think about it. I'm going to make sure we got some good stuff.
I love it. Have a great weekend, everybody. Thank you so much for watching.